Hey everybody, Boris Slash from PK4. Welcome to our Forex Weekly Technicals for 0707 to 07011 2014. Where are the trades? Well, relatively quiet week, of course, on the close here because of a U.S. holiday. But what is interesting, I think, as a takeaway, was that we see marked euro weakness as the week continued. Basically, a big failure at 37. This was actually noted very well by my friend Adam Butt at Forex Live, who had started to get short the euro after this failure at 37 right around here, ahead of the NFPs. And his recommendation really paid off as the trade started to really come down all the way down to the 35s, 36s, 35.90s on a support level. So where do we go from here? I mean, clearly, obviously, 37 now becomes the major resist level in this micro range that we're going to be probably experiencing in the month of July. But this 3550, 3500 is the big hold. The key point here, in my opinion, I think, is going to be U.S. rates again. It's really not going to be up to Europeans, but much more as to whether the market becomes convinced that U.S. data truly is turned positive and the Fed will now begin to consider seriously the prospect of tightening rates. Because until you get to see that point, you're still very much in a low volatility range-based trade. We don't have too much data on the European side this week. As a matter of fact, this whole week on the calendar is very, very, very tepid. The main event really is going to be Australian employment data. But generally, when you look at where we are positioning-wise here, 35 becomes, of course, the natural double bottom support test here. If we keep going to the downside, ahead of that 35.50 would be a more minor support that could be interesting. But any kind of a rally here really is going to start to run into a resistance at 3700. So unless we get big exogenous news, in other words, some sort of a shock the market doesn't anticipate on one side or the other side of the market, it looks to be like a very dull, low range trading trade, but very much with euro to the weak side. And I think it's worth watching here to see how euro trades against the other crosses, and if this weakness gets expressed even further and more intensely on the crosses. So we'll see how this plays out over the next week or so. Dollar yen is kind of interesting. So we did hold the 102s post the NFPs. Fridays we kind of held out and tested the 102s very early in Asian session on a natural stop hunt run, but held above 102s. I think the rubber hits the road this week in terms of whether dollar yen has truly made a very significant long-term bottom. And we've talked about the fact that this bottom here represents a very, if you look at this, let's just go back actually on a yearly basis. What's very, very important is the longer the base, technically, the longer the base, the stronger the prospect then for an upside breakout and a much longer upside trade. But if you have this base for a very long time that then breaks to the downside, this creates kind of like almost a crypt, a very, very tough upside cap on any kind of trade. For now, on a micro level, looking at this on a near-term basis, we're clearly holding above this 102. That's relatively bullish. We've made this double bottom here, right below the 101.50s. And the key thing, of course, now is can we mount a run towards the 102.50s? Assuming we essentially have no major negative reaction in the bond market is kind of hold around 260, maybe even begin to inch towards 265, 270. That's really going to be the key. If we can see the U.S. bonds go to 270 on the yield on a more positive assessment of U.S. economy, yes, 102.50 becomes very, very key. And then that becomes the really, really big level. Because remember, we've failed at least 2 or 3 times at this 102.50 level over the last 4 or 5 months. And that's going to be the big battle as to whether the market has finally turned. I think in many, many ways, this is for the next couple of weeks, dollar yen is going to be, even though it's not a very, very active pair, it's going to be the telltale sign of whether the dollar has kind of turned or not, whether the market is finally starting to become convinced that U.S. yields are on a permanent upward trend, or whether we're still going to be a false dawn, another disappointment, another retrenchment back to the 250 level. So watching these levels very carefully. For now, of course, the key positive thing is that 102 holds, and the next positive level that needs to happen is the 102.50 gets retaken and closed above. At that point, we've become a much deeper, better structure, and it could be setting ourselves up for a potential breakout to the upside. Pound dollar has traded very well. Last week we had this big breakout above 71, and kind of really holding bid here because, of course, pound is getting the benefit of the idea that UK will be the first one to raise rates, and economics in UK are still continuing to be quite strong. Even though that the PMI services missed a little bit, the underlying data in the PMI services on Thursday was still quite good. So cable still remains quite strong, and this is where we can take a look at, by the way, at the crosses when you can see that. Of course, everybody's favorite short trade at this point, but it is becoming very crowded. Nevertheless, looks quite good, which is the euro pound breaking the 79.50, still continues to the downside here. For now, this 80 now is the big resist on any kind of a trade up. But if we go back, I think we have to go back quite far. Let's go back to 3 years. We can see that this is making fresh lows now on a 3-year basis, and that's quite significant because it suggests that we may have longer term trend realignment here. Towards possibly 77 as an eventual trade to the downside. Bottom line is, euro pound is very much a sell the rallies. A long-term clear, a long-term downtrend is very much in place, and the fundamentals certainly support that trade. It may be some small short-term bounces here, but every bounce here does appear to be a very decent opportunity to sell. Now, Aussie dollar, on the other hand, is kind of an interesting story here because we had a big reversal in the Aussie dollar, and I think the big event risk this week is, of course, going to be the Australian employment data because that could really determine whether this was the 95 top, really was the top for this near-term rally. So RBA talked the Aussie down. We had mildly negative data, at the beginning of the week, and now if the employment data comes out relatively poor, we break this 9,300. And then, of course, the big test is going to be the 9,200. And if the 9,200 is given, that would be actually a quite negative structure in the Aussie dollar. Because what that would really suggest is that the market may be now in the mindset that the RBA is open to further rate cuts, not hikes, but rate cuts. And that could be a very interesting dynamic that has not been present in the market for quite a long time. We've had this big rally on the assumption that there'll be no more rate cuts. It's a yield play. Everybody wants it. We ran it all the way up to 95. But if the underlying dynamics in the Australian economy begin to show some serious weakness, all this doubt is going to start creeping in back into the marketplace, and we could have a further downside movement. For the time being, though, buying the Aussie on the support levels probably is going to be a relatively decent play, assuming that you don't have horrifically shocking news. If you do have horrifically shocking news, it could be a complete change of game plan, and a sell here would be just the beginning of a downtrend. This also, by the way, actually makes it interesting. Take a look at Aussie Kiwi, which has had a big bounce on this exact same idea, the exact same idea that Australian rates pretty much bottomed out and will no longer go down. Now you've seen the Aussie Kiwi get pushed back at 110, get pushed back at 108, and now coming back down to the support at 105. What I think is kind of interesting is, this has been a trade that everybody has been focused to the downside on a longer term basis. We held the 105s several times, but if you get a massive turn in the Australian dollar, the 105 given here would really open up the run towards the parity, and that could be a very interesting structure that the market so far has kind of not focused on for a long time. So that's a longer term trade, but it's worth watching this 105 break if it ever comes into play. For now, the 107, 105 seems to be the near term support for the Aussie Kiwi. Let's take a look at the dollar CAD, which has also been on a tear, just on a tear. Had a little bit of a bounce back on Friday on a comeback, but dollar CAD is another event risk this week that's really setting up, which is we have the Canadian employment coming up at the end of the week, and it's going to be pretty much the sole event risk for that day in North America, so it'll be worth watching. Dollar CAD, of course, is at 106, right at the yearly lows, suggesting Loonie has had just a massive rally as the underlying economy in Canada seems to have improved slightly, and that. First of all, oil prices going up, North American market starting to look good. Now, if you get the kind of follow through that you have in Canada, that you had in North America, that is, if Canada basically follows North America in its growth of jobs, which it tends to do quite a lot, you have a very positive dynamic on the Canadian crosses, and especially the Aussie CAD cross, which we were actually short, made a little bit of money here on the break of the parity. But I think this bounce back off of the break of parity could also present yet another opportunity. Any run towards parity, parity to 100, and a combination of weak Australian employment, strong Canadian employment could put us all the way down to 9,800 at the end of the week. So a weak Australian employment data set could really be a great entry point for potential stronger Canadian data point later in the week, and a potential move all the way out to 9,800. I really like this trade to the short side on any kind of a retrace back up above parity, assuming we get halfway decent fundamental confirmation that yes, indeed, Australia is weakening. Um, the other thing about Canada that's kind of interesting is, of course, we talked about the euro being weakness. Euro CAD, another break that took the 45s to the downside. It's consolidating here. The support here is, I guess, around 44.19, basically 44 ahead of the 44 level. This is the yearly double bottom, mirroring very much the dollar CAD trade. But euro is weaker than dollar, and I think any kind of euro weakness could push us down towards the 4,400. So this is yet, if you're going to trade CAD strength, I really like trading CAD strength against euro CAD as well, especially as we're very much coming up against this key support level for the yearly that, if broken, could really open up a run all the way out to 44, 42, 40, 4100 on a longer term basis. That's kind of how the week is shaping up. It's really going to be actually the calm dollar focus this week, with both Canada and Australia in the sights, with the Australia story being weak and the Canadian story being strong. And that could be worth very much a look as the week progresses. Wishing you guys the best of luck, the best of trading. Boris Schlossberg, over and out.